Is Tesla stock about to skyrocket, or is it headed for a crash? If you're thinking about investing in Tesla or just curious about where this EV giant is going, you're in the right place. In today's video, we're diving deep into Tesla stock, breaking down its financials, growth potential, risks, and what's next for Elon Musk's empire. Stick around because by the end, you'll have a clear picture of whether Tesla is a buy, hold, or sell. Let's get started. First, let's set the stage. Tesla isn't just a car company, it's a tech giant, an energy innovator, and a cultural phenomenon. Led by Elon Musk, Tesla's mission is to accelerate the world's transition to sustainable energy. They make electric vehicles, solar panels, battery storage systems, and even AI-powered software for self-driving cars. But how does this translate to its stock? As of July 2025, Tesla's stock price is hovering around $329.65. Its market cap is over $1 trillion, making it one of the most valuable companies in the world. But here's the thing, Tesla's stock has always been a roller coaster. It's known for wild swings, huge rallies followed by sharp drops. Why? Because Tesla is a growth stock, and investors are betting on its future potential, not just its current earnings. Let's look at the numbers. In 2024, Tesla delivered about 1.8 million vehicles, up from 1.4 million in 2022. That's impressive growth, but it's slower than the 50% annual growth Tesla targeted a few years ago. Still, Tesla dominates the EV market, holding about 20% of global EV sales. But competition is heating up, and we'll get to that later. For now, know that Tesla's stock price isn't just about cars, it's about energy, AI, and Elon's big bets. Look at this chart. Tesla's stock soared during the EV boom of 2020 to 2021, peaking at over $400 per share. But it's faced volatility since, with macroeconomic headwinds like rising interest rates and supply chain issues. So, is now a good time to invest? Let's break it down by looking at Tesla's financials. To understand Tesla's stock, we need to look at its financial health. Let's start with revenue. In 2024, Tesla reported revenue of around $100 billion, up about 15% from 2023. That's solid growth, but it's slower than the 50% plus growth rates we saw in 2020 and 2021. Why the slowdown? Well, EV demand has softened in some markets due to high interest rates and economic uncertainty. Plus, Tesla's been cutting prices to stay competitive, which impacts revenue growth. Now, let's talk profits. Tesla's net income in 2024 was about $15 billion, giving it a profit margin of roughly 15%. That's impressive for an automaker. Traditional car companies like Ford or GM typically have margins of 5 to 10%. Tesla's high margins come from its premium pricing, software sales, and regulatory credits, which are payments Tesla gets for selling zero-emission vehicles. But here's a key metric: free cash flow. In 2024, Tesla generated about $10 billion in free cash flow, which is money left after paying for operations and investments. This cash fuels Tesla's big projects like new factories and R&D for self-driving tech. However, Tesla's spending heavily, $12 billion in capital expenditures last year alone, so that cash pile isn't growing as fast as some investors hoped. Here's where Tesla's money comes from. About 85% of revenue is from car sales, 10% from energy storage and solar, and 5% from services like software updates and supercharging. That diversification is a strength, but cars are still the core of the business. Now, let's talk about Tesla's balance sheet. As of Q2 2025, Tesla has about $30 billion in cash and equivalents, which is a healthy cushion. Its debt is around $10 billion, giving it a low debt-to-equity ratio compared to competitors. This means Tesla's in a strong position to weather economic storms or fund new projects without relying heavily on borrowing. But not everything's rosy. Tesla's price-to-earnings ratio is around 60, much higher than the S&P 500 average of 25. This means investors are paying a premium for Tesla's future growth. If Tesla doesn't deliver on those expectations, the stock could take a hit. Speaking of expectations, let's look at what's driving Tesla's stock price. Tesla's stock price is driven by a mix of fundamentals and hype. Let's break down the key drivers. 1. EV market leadership. Tesla is still the king of EVs. It's got brand power, a loyal customer base, and a global network of factories in the US, China, and Europe. The Model Y was the best-selling vehicle globally in 2023, beating out gas-powered cars. That's huge. Tesla's vertical integration, making its own batteries, chips, and software, gives it a cost advantage over competitors. 2. Full self-driving and AI. Here's where things get exciting. Tesla's betting big on autonomous driving. Its FSD software is improving fast, and Elon Musk has said Tesla could launch a fully autonomous robotaxi service as early as 2026. If Tesla cracks self-driving, it could open a massive new revenue stream. Analysts estimate the robotaxi market could be worth $2 trillion by 2030. Tesla's also developing its Optimus humanoid robot, which could be a game-changer in industries like manufacturing. 3. Energy business. Tesla's energy division is growing fast. Its megapack battery systems are in high demand for grid storage, and Tesla's solar business is expanding. In 2024, energy storage deployments grew 50% year over year. This segment could become a bigger part of Tesla's revenue in the future. For new products, Tesla's rolling out new models like the Cybertruck, which is finally hitting the market in larger numbers, and a rumored $25,000 compact EV by late 2025. These could boost sales, especially in price-sensitive markets. But it's not all smooth sailing. Tesla's growth is slowing compared to competitors like BYD, which is gaining ground in China. Plus, macroeconomic factors like inflation and high interest rates are making consumers think twice about big purchases like EVs. So, while Tesla's got a lot going for it, there are risks we can't ignore. Investing in Tesla isn't a slam dunk. Here are the biggest risks you need to know. 1. Competition. The EV market is getting crowded. Companies like BYD, Volkswagen, and Rivian are ramping up production, and traditional automakers like Ford and GM are going all in on EVs. In China, Tesla's facing fierce competition from local players offering cheaper EVs. If Tesla loses market share, its stock could suffer. 2. High valuation. Tesla's P/E ratio of 60 means it's priced for perfection. If Tesla misses earnings targets or fails to deliver on FSD or robotaxis, investors could lose confidence, and the stock could drop fast. Compare that to BYD, which has a P/E of around 20, and you see why some call Tesla overvalued. 3. Dependence on Elon Musk. Elon Musk is Tesla's visionary, but he's also a risk. His controversial statements and focus on other ventures like X, SpaceX, and Neuralink can distract from Tesla's goals. If Elon steps back or loses focus, it could hurt investor sentiment. 4. Regulatory and supply chain risks. Tesla operates in a heavily regulated industry. Changes in EV subsidies or tariffs could impact sales. Plus, supply chain issues like shortages of chips or battery materials could slow production. 5. Macroeconomic headwinds. High interest rates make car loans more expensive, which hurts EV demand. If the economy enters a recession, luxury purchases like Tesla's could take a hit. Tesla's stock is volatile way more than the broader market. If you're investing, you need a strong stomach for those ups and downs. But what about the upside? Let's talk about Tesla's future. So, what's next for Tesla? Here are the big catalysts that could drive its stock higher. 1. Robotaxis and AI. If Tesla achieves full self-driving, it could transform the company. A robotaxi network could generate billions in high-margin revenue. Plus, Tesla's AI expertise could lead to licensing deals, where other companies pay to use its tech. 2. New markets and models. Tesla's expanding in markets like India and Southeast Asia, where EV adoption is just starting. A cheaper $25,000 EV could open up huge demand. The Cybertruck, while niche, is boosting Tesla's brand as an innovator. 3. Energy growth. Tesla's energy business is a sleeping giant. As governments push for renewable energy, Tesla's Megapack and solar products could see explosive growth. Some analysts predict the energy division could account for 20% of revenue by 2030. For manufacturing scale, Tesla's new factories in Mexico and expansion in China will boost production capacity. Lower costs from economies of scale could improve margins and make Tesla's EVs more affordable. Alright, let's wrap this up with my final take. Is Tesla a buy, hold, or sell? Buy. If you're a long-term investor who believes in Tesla's AI and energy potential, now could be a good time to buy, especially if the stock dips during market volatility. Tesla's leadership in EVs and its innovation pipeline make it a strong growth play. Hold. If you already own Tesla, holding makes sense. The stock's volatile, but its long-term potential is huge. Just be ready for a bumpy ride. Sell. If you're risk-averse or think Tesla's valuation is too high, you might consider selling, especially if you bought at a lower price. Taking profits during a rally isn't a bad move. Before we go, a quick reminder. I'm not a financial advisor, and this isn't financial advice. Always do your own research and consult a professional before investing. Stocks can go up or down, and past performance doesn't guarantee future results. That's it for our Tesla stock analysis. What do you think, bullish or bearish on Tesla? Drop your thoughts in the comments below, and let's get the conversation going. Thanks for watching, and I'll see you in the next one.